Welcome everyone, and thank you for attending our deep dive on stress testing. My name is Dan Sinreich, and I'm on the product management team with the MSCI Analytics here. This is the second in our series of webinars on MSCI Analytics into Eikon. Thank you for attending. Before we begin, I'd like to cover a few housekeeping items. First, some technical notes. There's no bell number for audio, so please use your device sound and plug in your headphones to listen to the webinar. Click the media player on your screen to enable sound and video and ensure that Flash is enabled on your browser. If the slides are stuck, please refresh your browser at the bottom of your audience console screen. If you have any technical difficulties during the webcast, please click on the help widgets. It's a yellow question mark that you can see. You can expand your slide window by clicking on the maximize icon on the top right of the window, or by dragging the bottom right corner of the slide area to expand at the top right corner of your screen, of your audience. There's a Q&A box in the upper right-hand corner. Please submit your questions to the speakers in this box. We will try to answer as many questions as we can during the last 5 to 10 minutes of the webinar. But if a fuller answer is needed or we run out of time, it'll be answered later via email. To see additional resources, refer to the window box below the slide deck. And finally, the link to the recorded webcast, a copy of the slides, and other resources will be emailed to you after the conclusion of the event. You may also access the webcast on demand using the same audience link that you used to get into the webcast today. So without any further ado, let's go ahead and get started here. So today I'm joined by two experts. First, Puneet Kumar, he's on our consulting team with MSCI, has a lot of experience working directly with stress testing with very large and sophisticated institutional investors. He'll go through the deep dive on stress testing. Then Stephanie Greiner will follow. She's a solutions consultant manager with Refinitiv Portfolio Analytics and has a lot of experience on Eikon. And together we'll show you how we can do deep dives on Eikon using the MSCI analytics that have been integrated. So thank you to both for presenting. Before we get going, we thought we'd do a little audience participation. As I mentioned, this is the second of our series of webinars of analytics integrated into Eikon. If you're able to attend the first one, please answer yes. And if you haven't, please answer no, just to let us know if you're able to attend the first one. This will help us as we do the Q&A, and it will also help us tailor our comments a little bit more to the audience. All right, so I'll let it go for just another 5 seconds, and then we'll see what the results are. Looks like, okay, we've got about half of you submitted. All right, so let's see where we are. Okay, so interestingly enough, it's just a little over half did not attend. So thank you very much. We'll keep that in mind. And as we talk through this, both Puneet and Stephanie will as well. So without any further ado, I will man the Q&A and answer questions and come at the end. But I'll turn it over to Puneet here to take us through stress testing and the deep dive on it. So over to you, Puneet.
Thank you, Dan, and a very good morning to everybody. Very glad to be here to talk about the topic of stress testing, which is a very relevant topic given the volatile times we are living in. In today's presentation, we want to start with talking about what is stress testing and why is that an important discipline in the field of risk management. We would give some color on how stress testing works mechanically. We will review some best practice guidelines that MSCI researchers have come up with after many years of research in this area. We will then take an example of 4 COVID scenarios that we published recently and show how we applied those guidelines into building of those scenarios. Finally, my co-presenter Stephanie will show how can you run stress tests in Refinitiv Eikon. All right, let's get started. So I want to start with talking about the importance of the discipline of stress testing in the function of risk management. Stress testing is a discipline which allows risk managers to bring their subjective views and intuition in the process. These subjective views are driven by economic reasoning, fresh data, and honestly, a fair amount of judgment. In that respect, it is a nice complement to other risk measures like VAR and standard deviation that are based on historical data, and there is a minimal amount of subjectivity involved. Through stress testing, a risk manager can make a portfolio undergo a hypothetical market scenario, however likely or unlikely, and understand the impact on the portfolio in simple dollar terms. This impact analysis can be used to understand the points of vulnerabilities in the portfolio. The manager can then hedge against those vulnerabilities or rebalance to reduce potential exposures. A bit of a health warning though, stress testing is not about forecasting what will happen. It is about modeling likely or unlikely scenarios of the world and estimating their impact on the investment portfolio. There's a range of possibilities at any given time, and these possibilities also evolve going forward as fresh data arrives. So why should we have room for human intuition and judgment in the process of risk management? Let's take an example of some recent market events which illustrate this point. On the bar chart to the left, we are showing the performance of style factors of Barra Global Equity Model between 21st Feb to 23rd March this year. The performance here is expressed in the units of the standard deviation as of 20th Feb 2020. We can see here that there are some extreme moves visible. The leverage factor, which goes long on equities with high leverage on their balance sheet and short on equities with low leverage, experienced a drawdown of up to 15 standard deviation. The profitability factor, on the other hand, saw a positive return of more than 7 standard deviations. This means that investors bought into the high quality companies with strong profitability and sold off highly levered, poor quality stocks. The chart on the right-hand side shows the trend in correlations of some of these style factors with the global equity market. So you see not only the returns of some factors were extreme, but we also see their correlations break down. Leverage factor returns, for example, became highly correlated with global equity market returns, whereas the investment quality, profitabilities, correlations came crashing down. Now, what happened with the dividend yield factor was also quite unique. Dividend yield factor has been traditionally thought of as a defensive factor because high dividend yield stocks act as kind of a bond proxy. But in the recent outbreak of COVID, investors became very concerned about the ability of the firms to pay their dividends. Hence, there was a sharp drawdown in the factor. At the same time, we saw a big spike in its correlation with the global equity market. The impact of these unusual movement of these risk factors is quite evident on sample value portfolio that we have. As of 21st Feb, the risk model predicted a VAR of 9.3% over the following 21 days with 99% confidence. However, what happened was that portfolio lost nearly 4 times that value due to extreme risk factor movements we showed in the previous slide. Additionally, if we look at the contribution to the realized returns from certain factors, they also changed significantly in comparison to the prediction from the VAR model. This shows the impact of some of the correlation breakdowns that we saw in the previous slide. So the bottom line from these 2 slides is that extreme movements in risk factors can happen without notice. And when they do, the relationship between those risk factors also change without notice. So we cannot fully depend on backward-looking risk measures and must complement them with stress testing, which allows for subjective views on both the magnitude of the risk factor movements as well as the relationship between them. Now that we have understood the importance of stress testing in risk management, let us spend some time talking about the mechanics behind the stress testing. Every stress test starts with a definition of a future state of the world, which we intend to translate into the P&L of the portfolio. The scenario definition is often done by taking subjective views on some risk factors. The P&L calculation is done by using the pricing models to fully evaluate the portfolio using many risk factors. So it becomes important that we have accurate pricing models for the securities which cover the detailed terms and conditions as well as all the relevant risk factors that are applicable for that particular security. Refinitiv Eikon uses MSCI's best-in-breed pricing models for this purpose. However, there's one more thing to worry here. Usually, the risk manager has subjective views on just a handful of risk factors, but the portfolio is exposed to many, many more risk factors, which is why we need a propagation mechanism to be able to propagate the shocks from a handful of factors to all the other risk factors. The most popular approach to doing this is through multiple linear regression. We use historical data to fit a multiple linear regression model in which shocked risk factors act as independent variables and other risk factors act as dependent variables. This mechanism implies that while we can take subjective views on some risk factors, the propagation to other risk factors still uses historical correlations. So the issue of which correlations are robust and which aren't becomes really important. And we will revisit that later in the presentation when we talk about our best practices. I also want to spend some time on different types of risk factors that are available for different use cases. This triangle shows the full franchise of risk factors available at MSCI. As we go from the bottom to the top, the number of risk factors decrease, but at the same time, the horizon in which they become relevant also increases. At the bottom of the triangle, we have several pricing risk factors that are meant to provide a full revaluation of the portfolio. Equity time series, interest, key rates, commodity prices, FX time series, etc. These risk factors are heavily used in the calculation of value at risk measures with short horizon. On the other extreme, we have only a handful of risk factors, GDP growth rates and inflation, which correspond really well with multiple years of risk horizon. In between the two extremes, we have risk factors at varying level of granularity applicable for portfolio management and asset allocation use cases. We can take subjective views on risk factors at any level or across several levels, and we have models that are able to translate those views at any level to all the way down to the granular pricing risk factors to compute the P&L of the portfolio. The practical example that we will show today will take views at the very top on the GDP growth rate and translate them all the way down to the pricing risk factors at the bottom. So far, we have made a case for stress testing being a powerful tool for expressing subjectivity of a risk manager into the risk management process. Now we want to touch on some best practices and guidelines that can be helpful in defining stress tests. As mentioned before, stress testing starts with modeling a future scenario of the world. The scenario should be complete. The scenario should be consistent. Completeness dictates that we describe a scenario in as much details as possible. We should not leave much room for ambiguity. Consistency dictates that our subjective views should be grounded in sound economic reasoning and should describe a realistic state of the world. Now let us take some examples to understand both points in more details. Let us say we want to estimate the impact of oil shock on our equity portfolio. We shock the oil risk factor down by 20% and then let scenario propagation mechanism do its job. As mentioned before, a linear regression model will be fit with oil as the independent variable and equity as the dependent variable. If we choose a really long history of data going back to 1970 to train this model, we get a model which predicts that equities will not move by much. Also, the explanatory power of this model is pretty bad. So what are we doing wrong over here? So if we take a closer look at the data, we will see that relationship between oil and equities is very dependent on the regime we are in. If the oil price is going down because there is demand shock, then there is a significantly positive beta between oil and equities. The events in 2008 corresponded to this regime, whereas if the oil prices are going down because there is a supply shock, then there is a negative beta between equity and oil prices. This is what happened in 1986 supply glut when cheaper oil benefited economy. So what lessons can we draw from this? The example shows the importance of having a narrative in mind. There are two things that we could have done here. First, we could have used a specific time window to train our model where events like our narrative took place, or we could explicitly define what equity prices we're doing in our scenario. But the prerequisite of doing either of these steps is to have a narrative in mind. Just saying oil is going down is probably not enough. We also must define what else is happening in the world. Cross-asset class correlations can be quite unstable and regime dependent. Having a narrative in mind will help us avoid depending too much on them. Now let us address the issue of consistency. Suppose, to be complete, we specify a subjective view that equity prices of energy companies are going down, as well as the credit spreads are also narrowing. Now, is this definition consistent? When we look at the historical data, there has always been a negative correlation between the equity prices and the credit spreads of the companies. In other words, when equity prices are going down, we can expect the same company to become more likely to default. There is an economic rationale behind why this should be the case. However, there is no good economic justification behind a view that goes in the opposite direction. So what lessons can we draw from this? If we prescribe too many shocks, we are running the danger of coming up with a scenario which can be unrealistic and noisy. So you see there is a tension between principles of completeness and consistency. One says more risk factor, the better. The other one says just the opposite. The critical trade-off between the two is achieved at 10 or fewer shocks. And even there, we should use that budget wisely. There are some correlations that are robust even in stressed conditions. For example, correlation between key rates of a yield curve can probably be trusted. So we don't need to specify shocks for each key rate individually. One or two is enough. Correlation between oil and equity, however, couldn't be dependent upon, and we may need to have specific views on both of them in a single stress test. So in summary, stress testing is not a push-the-button exercise. It is a combination of art and science. Science part is provided by the detailed pricing models and the historical data. The art lies in defining a state of the world and determining what correlations are to be trusted and what are to be overridden by our narrative. Now, what are the things that we recommend doing? We recommend to always start with a well-defined economic thesis behind the stress test. Such a thesis can be arrived via internal discussion with economists or reading papers from organizations like IMF. Also, subjectivity of the stress test warrants that we keep updating our scenarios as new information becomes available. Given that there is a fair amount of judgment involved, we should also consider varying levels of severity of the shocks to understand the sensitivity of our portfolio to our views. Finally, we should also consider the time horizon in which a stress test event will play out on our portfolio. Things that we don't recommend, on the other hand, is building a stress test which are either incomplete or inconsistent. All right, so let us get into a practical example of how MSCI researchers built the recently published scenarios on COVID-19. So we built 4 different narratives about the future path this pandemic can take from here. We based these narratives on an IMF paper, which was released in April 2020. You can find the name of the paper in the footnote. We assigned shapes to these scenarios to denote their severity. The least severe is a V-shaped scenario, which assumes that the pandemic will go away in the second half of 2020, and the containment measures will be lifted quite rapidly. There will be short-term shock to the GDP in this scenario. However, there won't be any long-term shocks. The financial conditions will also ease in second half of 2020, and as a result, rates, FX, commodity, they will trend towards their pre-COVID levels. A slightly worse scenario is a U-shaped scenario, where again the pandemic fades mostly in second half of 2020. However, the containment measures are lifted slowly. There are deeper short-term GDP shocks in this scenario, but mild long-term GDP shocks. The swoosh-shaped scenario is like a Nike logo and imagines a state of the world where there is a recurring outbreak either in 2020 or 2021. The equity risk premium remains elevated throughout. Additionally, what happens in this scenario is that the peripheral European countries also come under a bit of pressure due to their rising default risk. The L-shaped scenario is the worst scenario. There is a chance of a second wave both in 2020 and 2021, according to the scenario. And there are both short-term and long-term growth shocks to the GDP. The rates will stay low, and the spread of peripheral European economies increase sharply. So since these IMF scenarios take view on the risk factors at the very top of the triangle that we showed earlier, namely the GDP growth rates, we need a model to propagate those views to the pricing factors at the bottom. Now, we cannot use a regression-based approach here because the data are of different frequencies, and GDP data is also often quite smooth. So for this purpose, we use our MSCI macroeconomic risk model. Now, macroeconomic risk model uses a cash flow-based approach to come up with the expected levels of the equity prices under different macroeconomic assumptions. Now, there are 4 different inputs that go into the model: the short-term growth rate, the long-term growth rate, the equity risk premium, and the risk-free rate. The framework of dividend growth model is useful in understanding how this model works. The cash flows in the numerator are affected by the growth parameters. The short-term growth rate shock will shock only the first few terms, whereas if you look at the long-term growth shock, they will affect all the longer-term earnings. The denominator in the equation that's shown, it's a combination of risk-free rate and equity risk premium. So if we are in a high equity risk premium environment, we can expect the equity prices to fall. So the inputs of these models align really well with the scenarios that were provided by the IMF. So we took those inputs and we plugged them into the macroeconomic risk model, and we generated the path followed by the real GDP as predicted by the model. So as can be seen on the screen, the slope of recovery for the V-shaped scenario is the steepest, and the economy recovers back to its previous level in a couple of years. Whereas the L-shaped scenario, on the other hand, takes the real GDP to the greatest depths and takes the longest time to recover. It takes until 2030 to reach the level which was kind of the pre-COVID level. Now remember that we said in our best practice recommendation that we should also consider the time horizon of these stress tests. Now, the forecast from the macroeconomic model is long-term. But if we follow the arguments of efficient market hypothesis, then we assume that market participants will price in their long-term expectations and risk premium, and they will be quick to act on it, which will result in asset prices changing instantaneously or in a matter of few days. This is the instantaneous drawdown that we expect to capture via this stress tests. However, in reality, for really long-drawn scenarios, while there are clear, trigger points at certain times, when new information becomes available, it is very hard to predict the horizon over which the results will play out. And then there are confounding effects of other events happening in the market. That being said, we think as of May 20th, we were still in the short term, and COVID was the most important factor weighing on investors' minds. We did a reasonability check of our model results by comparing them with the actual price levels of the equity market. It seemed like market went down to levels predicted by the swoosh-shaped recovery, but recovered back to the levels of a V-shaped recovery. But this is assuming that COVID is the only thing that is driving market prices. While this may have been true, as of May 20th, the same can't remain true as we go forward in time. This brings me to the definition of the stress tests. Now, I want to walk everyone through our approach behind defining this stress test. So first of all, notice how we are trying to model a complete state of the world by modeling equities in two different regions, interest rates, credit spread shocks for different qualities of bonds, crude oil, and FX rates. Also, within interest rates, you can see that we are only taking views on 10-year rates and not on the entire yield curve on all the key rates. Now, the IMF scenarios and our macro model was able to provide us with the implied equity returns for US and European Union for different scenarios. For credit spread shocks, we actually looked at the historical relationship between spreads and equity prices in US and Eurozone during the global financial crisis. And we use that relationship to model the spread shocks for different quality bonds in different regions, conditional on the equity shock outputs that we got from the macro model. IMF also provided the expected levels for FX, oil, and interest rates for V-shaped scenario. But to fill in the levels for more severe scenarios, for these factors, we applied a judgment, and that judgment was arrived at after extensive discussions within MSCI research team. So in summary, we used a combination of many ingredients in designing the scenarios: narrative from IMF, a sophisticated macroeconomic risk model from MSCI, historical data, as well as judgment and subjectivity of the researchers. And these are all the ingredients that go behind designing a stress test. Now, when we ran these stress tests on different type of portfolios, we observed these results. The V-shaped scenario is the least severe one, and the possibility of that actually led to some small profits for global equity portfolio and high yield portfolio. Whereas the L-shaped scenario produced the worst outcome for all the portfolios, except for US Treasury bonds. The other scenarios lie somewhere in between. So this kind of concludes the my section on the theory and the best practices and the motivation behind stress test. But before I hand you off to my co-presenter Stephanie, I want to take a poll here where if you could indicate what shape do you feel the recovery will take, and I will give you guys a few seconds to express those views. All right, let's see if we have some results. Oh, great. Okay, so most of the participants feel that it will be a swoosh-shaped recovery. That's really, really interesting. Interestingly, the least number of you think that it's going to be a V-shaped recovery. So that's really interesting, and thanks for all your inputs. Now let me hand the wheels over to my co-presenter Stephanie, who is going to take you through how to set up one of the 4 scenarios in Refinitiv Eikon.
Okay, thank you very much, Puneet, and thanks everybody for joining us today. So what I'd like to do is take you through a demonstration that was created in Eikon, and we'll show you how you can create a custom scenario similar to what Puneet just spoke about. The scenario that I have created here is the U-shaped scenario, not based on any particular belief, but just the one that we chose for demonstration. So I know there's a little less than half of you that were on the webinar the last time, but for a refresher for those that were, and for a little bit of a background for those that weren't, what I'm doing is, MSCI's repricing simulation models are fully integrated and built into Eikon. And so here the screenshot just shows that's exactly where I am, where I'm going to take you through how you'd build a customized scenario. So moving back to when we last had our webinar on May 7th, for those of you that were there, you may recall, and for those of you that weren't, just to review, we showed how you could take a portfolio. We ran it through the optimizer for a minimization of tracking error. We then took that portfolio and we created a report that showed how that portfolio would behave under several historical scenarios and particular shocks. And at that time, we did that analysis. I'll go to the next slide. That analysis showed, well, what would happen in a Black Monday 1987 scenario? What would happen in the fall 2008 crisis scenario? We stressed crude oil up 20%. We stressed U.S. rates. We stressed the MSCI World Index. And at the time, we went through the analysis that showed how the portfolio would react to each of those scenarios, but to each of them independent of the other. It showed it nicely on one view, but the results were each independent scenario not dependent on the other. So today, as Puneet went through these COVID examples, we wanted to show you how you can create a custom scenario that indeed goes back and reprices the portfolio looking at several shocks in tandem. So here, I'm just going to create a brand new scenario in Eikon. And I gave it a name, COVID-19, description coronavirus. Obviously, there's lots of flexibility there. And then here is, I'm going to start to create and build the components of what I've chosen to do the U-shaped scenario. I'm trying to mimic that. And obviously, as Puneet mentioned, you can build these to what you believe might be happening in the market. So here, I'll first choose crude oil. That's being shocked positive 30.7%. And in this, the view, when we see it, I want to show the result of the percent change of the portfolio. You can look at the total value of the portfolio or the percent change of the portfolio. I'm then also going to go to the indices. I'm going to add the S&P 500. I'm going to shock that down 7.9%. I'm then also going to add the Europe 600 stocks index. I'm going to shock that down 8.6%. And again, I'm going to view it as the change in portfolio. The euro, a very small basis point increase in the euro. Put that in the model. U.S. interest rates, you mentioned, maybe remember Puneet said, this model, they only shock the 10-year. You can, of course, shock any, there's 17 points in the curve that you can shock. In this particular case, we're only shocking the 10-year, the U.S. rates. Similar with Germany, 10-year, a much smaller increase. And then Italian rates, again, a down shock on the 10-year. And so I put those all in. Now here are all of the components that I have in this custom scenario, trying to mimic that U-shape analysis for COVID-19. Just a reminder, each one of these has their own parameters and settings and shocks that I put in. And then basically it takes my portfolio, which is actually the same portfolio that we had used during the last webinar when we optimized a portfolio, like I said earlier, to minimize tracking error with a tilt toward growth. That's the same portfolio that I'm using here, for example. And you could just see the analysis brings you back some graphics, which you can remove, and a lot of detailed analysis. Let me zoom in here. I'll remove the graphs, and then I'll zoom in again. And basically what you see here is my portfolio sorted by economic sector. That's the way I chose to see it. You can see the value and weight in each one. And here, this column, COVID-19 impact, this is the scenario that I built. So this is showing the portfolio, how it's repriced. The risk is minus 6.16%, with that custom scenario of the COVID-19 U-shaped impact. Here is the risk, right? So you can see again, down 6%, and then you can see how it moves, or how the risk is by each economic sector. And then on this column at the right, this shows me just in percentage the impact. So information technology is estimated to go down by 3.27%. That represents over 53% of the total risk. And then you remember Puneet mentioned, value at risk, really, really important analysis, very valuable, but probably a bit more valuable when used in tandem or complementary to something like scenario analysis. So in this report, I've also included a column that will show I've used a historical methodology with 95% probability. I also can see the value at risk analysis here as well, so I can look at both. So here you could just see how I can take information technology and I can look at all of the individual stocks in the portfolio and see how each individual stock reprices under the model. And let me zoom in. And then, for example, within that sector, it's noted that Eikon, for example, is the stock with the highest percentage of that risk adjustment under the model. So you can drill down to the stock level. As I said earlier, I did include the value at risk measures. I could have included incremental VAR, conditional VAR, marginal VAR, took value at risk. And again, as I said earlier, I used a historical methodology. You can also use Monte Carlo or a parametric methodology. But I had also included that in my report. Again, building on what Puneet mentioned, where both of these in tandem are most valuable. Now let's assume time passes or the markets move. I want to go and adjust this model. So let's assume crude oil moves. I can very easily go in, as shown here. I can go in back into my existing custom model, click crude oil, and I'll change that from, it was 30.6%, I'll change it to 20%, for example, and then I can rerun. Or I could create an entirely new model. So using the same methods, you could go in and create an L-shaped, a V-shaped, a U-shaped, et cetera, or swoosh. You can have as many of them as you wish. So that's a brief look at how you can really put this into practice in Eikon, how easily you can build custom scenarios. And with that, before we get to the Q&A, Dan, I see we have a poll question here. Yes. So we'd like everybody to answer this. We'll wait a few seconds before we move on to the Q&A. So in terms of, we'd be real interested to hear what other topics you might want to hear about on future webinars with regard to this topic. Okay, maybe wait about 5 more seconds. Okay. Optimization, very interesting. Okay. Super. Thanks very much, everybody, for your participation in that poll. Yep. So now at this point, Dan, I'll turn it back to you so you can manage the Q&A for us. Great.
Yeah, thanks, Stephanie. That was great. Thank you. Great overview of the analytics. And again, these have been integrated between MSCI and Refinitiv within Eikon. So when you do create those shocks that Stephanie was showing, and that then you can, those analytics go directly to MSCI, assets get repriced. We really have the full power of having all that on Eikon, and then the analytics behind it are solid straight from MSCI. So thank you for that, Stephanie. So let's see, couple questions. So 2 questions, similar. What app is being used to build this, and how do we access this? John, so John answered it on the chat, but I'll just mention it. The app that Stephanie showed is Eikon. It's in the Refinitiv workspace /board/reports. So that's how you get to it.
Yeah, no, that is fully integrated in Eikon. I should mention it is an add-on component to our portfolio analytics solution, but I was absolutely running that actually in a browser version of Eikon.
Perfect. So thanks, Stephanie. So those are two questions. Let's see. One question here: does your system work with Jacobi? I actually don't know what Jacobi is. Maybe. I'm not sure if it's a Refinitiv or Eikon specific term that John or Stephanie can answer.
I also am not sure what Jacobi is. I don't know if John DeVito is on audio. I'm not sure we have John on audio. We're going to have to, we'll absolutely get back with you on that question.
Great. Okay, no problem. So we'll get back to you on that. Let's see. One other question. How do I stay updated on when these webinars come available? We certainly, maybe Stephanie, you want to take that one?
Yeah, we certainly, we try to message these across social media, on our websites. Our frontline teams are always trying to make sure that they message the availability of these webinars to their clients. But if you go on to Refinitiv's website, you would see where we have many webinars across many topics, and you can be emailed the link to the registration page.
Yeah, perfect. Okay, here's a couple of questions. Thanks, Stephanie. That's perfect. A couple questions for Puneet specifically. Let's see. What fundamental aspects are considered when calculating the equity risk premiums or the growth rate percentages? To what degree can these vary by the four situations? Puneet, do you want to take that?
Yes. So to answer the latter part of the question, to what degree can these vary by the four situations? Let me take you back to the slide that we had.
Let me know if you need help moving it, Puneet, by any chance. Okay, there you go.
Yeah. Do you see it?
Yeah, looks good.
Okay, so the equity risk premium and the growth rates are tabulated here for the four scenarios. So as you can see, as the severity of the scenario increases from V-shaped to U-shaped to swoosh-shaped to L-shaped, the equity risk premium actually increases continually as well. And you see the same effect can be seen in 2-year growth rate shock and long-term growth rate shock for the GDP. Now, as for the inner workings of the model, it's like I said, it's a sophisticated model, and we did try to give like a simplistic view of trying to understand, how can you understand about the model. But to dig into the details behind the model, you will have to speak to one of our researchers who are responsible for building and running these models. So we'll have to take that back.
Yeah, we'll take that back. It's and there's a similar question too. So it is based on. So I'll answer both, right? It is based on a macroeconomic model that takes GDP and inflation into account. That model was created. So these stress tests were created using that model, and just contact us afterwards and we'll work through the details of that. That model is not yet available to clients either on Eikon or MSCI, but we are using it to define these shocks that you see on this slide, the V-shaped, the U-shaped. So we are using that model to create it. our view right now, and this is what our clients are doing, and what should happen with Eikon as well, is we wanted to show you how we created these values for these stress tests. Our expectation is that clients will have their own methods of determining these V, U shapes, U shapes, or their own. Will have their own way of determining these shocks. Sometimes it's using a macroeconomic model like we do. Sometimes it's potentially using other fundamental financial models. Sometimes it's getting data from sell side models and things like that. So the key is that, and it's important to understand what the values are and how they were determined. Here, the key is that once you do have them, you can enter them into Eikon and you can run the stress test. So I do want to highlight that. But do please, we have your name here, so yeah, we'll follow up afterwards with more details on the macroeconomic model, at least how where it is today from MSCI. Okay, let me see. We do have a couple more. I think this one's also, Puneet, I'll turn this one to you. It says, the models depicted assume continuation of Fed intervention QE, or whatever we call it. How do you model scenarios without QE, without quantitative easing? How do you model scenarios without that in a natural state?
Well, I mean, if there is no quantitative easing, then probably you can expect a little bit of more stress on the credit spreads. Those asset classes are, going to increase. So, you can adjust, the severity of the different shocks that we provided over here to conform with the views that, Fed is not really stepping in. In fact, for the, peripheral economic shock that we did for Italy, we kind of, assumed some of it that there will be tensions behind, kind of a bailout package because of the, supranational structure of the European Union to be given to the peripheral economies, right? So, the answer here is that it will be a combination of, the sovereign spread risks increasing and the credit spread increasing by more than normally what they would have, with the Fed intervention.
Great, thanks, Puneet. Couple more questions. These are good. Please keep sending them. So, do you have any case study or webinar on stress testing that is being implemented on a capital project in order for an investor to understand the risk involved in his or her development project? I'll take this one. Generally, no. At least we at MSCI don't. We tend to focus on investment portfolios across asset classes, stocks, bonds, commodities, private equity, private real estate, derivatives, all that sort of stuff. Anything that's in an investment portfolio. So our financial models basically will reprice assets and come up with hypothetical values based on the shocks. So just like Puneet is showing here, these different scenarios, we have pricing models that basically say, okay, look, if spreads do this, this is what will happen to my derivative, to my bond, to my equity, and so on. I kind of touched on that on the first webinar. So we don't really have clients who use stress testing for capital projects and to understand the risk in that. It's not really, to be honest, our forte. Our forte is an investment portfolio and computing hypothetical prices based on changes in market conditions, which is what we went through here. Here's another question which I'll take, and I'll probably turn it over to Puneet, but I'll take a shot at it. Is it possible to model the impact of COVID-19 on fintech startups? So I assume this means obviously a private company, a private equity company. It's possible to estimate it. The way we would go about it is to apply these same stress tests, but take a portfolio that looks as close as possible to those fintech startups. So you may want to look at small cap fintech type companies that have already gone public. There's a whole discussion and debate we can have about private equity, and in fact, there's an MSCI webinar if you're interested in about a week and a half, which I'll be conducting with one of our researchers on private equity stress testing, and you can get very detailed. The bottom line is that private equity looks like a public equity. We have the same clients. Look, those companies have the same clients. They have the same pool of employees. They have the same supply chains, even if they're startups, there's a supply chain in the employees. They're faced by the same macro environment as a public company. So there's a lot of relationship there. On the MSCI side, we also will have private equity, private equity shocks that we can apply. Within Eikon, and what many of our clients still do, even within MSCI, they'll take a representative portfolio of companies that look like that private equity company, and then apply the same stress test that Puneet was showing. It'll give you a sense. Many clients will then maybe lever up the beta, whatever that result is, and it becomes somewhat of an estimation exercise if you don't have access to private equity factors. So I would start there with that approach by taking a representative portfolio and applying these stress tests. Anything else to add to that, Puneet? From your side?
No, I think you said it. Dan, that the way we model these investments is through our private equity model.
Yeah.
And then, in the absence of that, what many clients also do, as you correctly mentioned, is to use public proxy equivalence with the adjustments for the beta, at the right level. So first of all, you deliver those equity proxies that you are using as your proxies, and then you apply the relevant leverage on top of it, right, to get at the right kind of beta. So that will kind of give you a very good estimate of where these some of these fintech startups should be, given these stress tests.
Yeah, and then exactly, and the beta we've seen, again, this is very high level, so you really have to use your own, but we can send you papers if you're interested. Just contact us. The beta we've seen is between 1.2, 1.3, 1.4 roughly, and it depends what kind of private equity, obviously. So that's the range we're talking about. It's not a 3x beta, it's not a 2x. It's in that 1 point less than 5 type beta. So okay, just keep that in mind. All right, let's see if there's any other questions. I think that's it. I think we've answered all of them. So yeah, I think we've answered it. So that's it. So that's the console. Thank you for sending those along. So let me go ahead and close it up. Thank you to Puneet. Thank you to Stephanie. That was wonderful. If you're interested in a free trial of Eikon and MSCI, the risk analytics tool, please click on the window box to your left, and you'll be able to get a free trial. And at the end here, you'll see a survey popping up on your screen once it's over. Please share your feedback so we can improve and create more of these webinars for what's interesting to you. With that, I'll close it, and thank you very much for your time today. Thank you.
Thank you.
Thank you, everybody.